Good morning, everyone watching live on BAM YouTube. Let me know in the comments which market you are tuning in from. The hot sheet covers what you need to know about the real estate industry in a 24-hour time period. On today's hot sheet, I will discuss housing market affordability, a new low for home flipping profits, the best markets for single-family rentals, and updates on the banking crisis and recession. Today is March 28, 2023. I am Byron Lazine, and the hot sheet starts now. All right, welcome back to the hot sheet. Love for you to hit the thumbs up and consider sharing this with one person who wants a 24-hour look back on housing. It's the best way to support the show right now. And let's jump into spiked mortgage rates, which have pushed housing market affordability to levels not seen since the housing bubble. I'm gonna go over where 9 experts see interest rates going next. This is written by Lance Lambert of Fortune. I'm glad he broke it down. We've been talking about affordability a lot on this show. It's the biggest issue facing real estate along with inventory, and those go side by side. According to the Federal Reserve Bank of Atlanta, the pandemic has coincided with a historic deterioration in housing affordability. That's the result of mortgage rates spiking from 3% to over 6% in 2022, just after U.S. home prices spiked 41% during the pandemic housing boom. Thank you, Jerome Powell, for completely destroying affordability in housing. He wants to stop inflation, but he's made it so that nobody can afford home ownership. In fact, housing affordability, as measured by Atlanta Fed in December 2022, was worse than any point in the lead up to the housing bubble in 2008. All right, we have all the charts down below. We've got 8 charts today. There's one link down below where you can get your daily download of charts and all of our sources, including this source here. Okay, let's jump into our first chart. U.S. Housing affordability is worse now than it was in 2008. Federal Reserve Bank of Atlanta's National Home Ownership Affordability Monitor, HOAM, it's like ham with an O, index, more affordable housing market. You can see there pre 2008 or 2008 rather, 2008 to right about 2008, and then a less affordable housing market, 2016, and you can see where we are today in 2022, lower than at any point even before 2008. In 2007, we've never been lower than this number looking back the last 15 years, 69.9. We've jumped up a touch here to start 2023, but bottoming out at the end of 2022. Again, completely lower than even the run-up of the 2008 crisis. Okay, so more affordable would be at the top there. Anything over the 100. So from about 2009-ish till really 2021, beginning of 2022, till Jerome Powell started to to put housing in a recession, you saw a considerably affordable housing market. It's not what we have today. Okay, how can housing affordability be improved heading forward? There are only 3 levers that can help here: rising incomes, falling home prices, or falling mortgage rates. Those are the only 3 things that can happen. Incomes, while the job market has been strong, have not been accelerating as fast as mortgage rates have been rising, and certainly falling home prices hasn't happened as quickly as they went up the last couple of years. But truth be told, the lever with the best chance of making a difference is, according to Lance Lambert in his piece, is mortgage rates. Okay, so we need those mortgage rates to come down. We'll see where they're at the end of the show here. We'll see where the 10-year is today. We want to follow the 10-year to see where those mortgage rates are going. Unlike home prices, which are historically loath to fall, mortgage rates are volatile. They can swing down quickly if financial markets were to loosen. We've seen extreme volatility so far this year when it comes to the mortgage rate. Drivers of housing affordability, we've got a chart here down below as well. according to the Federal Reserve Bank of Atlanta. Okay, so the income component is just not up all that much. It's up a little bit, but it's not up all that much. House price component we saw, in the last, call it 9 months, we've seen significant help there, according to Case Shiller, where we have our first year over year, home price decline. And then mortgage rate component has hurt us significantly here, for affordability, especially in the last year. The pandemic housing boom's 41% run up in U.S. home prices, coupled with mortgage rates spiking from 3 to 6, has seen this housing affordability just completely deteriorate. Now, let's look at where these 9 banks are, or 9 experts rather, are going to tell us where mortgage rates are going to go. Bank of America. Research at the investment bank expect mortgage rates to fall to 5.25% by the end of 2023. So B of A on the board by the end of 2023 at 5.25. Let me know in the comments if you've got the over or under on B of A by the end of 2023. Mortgage banker associations. The group thinks rates will average 6.4 in Q1, 6.1 in Q2, 5.7 in Q3, and 5.3 in Q4. So they think in Q4 will end at 5.3. So very similar to Bank of America. Let me know if you're over or under that 5.25 mark. Okay. They think in 2024 and 2025, it's going to get considerably better. Will be in the fours. Windermere Real Estate. So right now we've got Mortgage Banker Association and B of A both saying we're going to end the year around 5.25. Over or under on that in the comments. Windermere Real Estate, the leading real estate based company, projects that the 30-year will end the year at 5.6. Okay, Q4 is going to be 5.6. Let's stick with the over under of 5.25. Where are you at on that? Mortgage Stanley. They believe the mortgage rate will fall to 6% by the end of 2023. 6% would be, from where we're at right now. Every time we get to 6, we do see activity spurt right up. We see mortgage applications pop when we get to that number. 5.5 and 5 is kind of, a dream scenario right now in terms of bringing affordability down. So Mortgage Stanley at 6%. Fannie Mae believes that we're going to average 6.5%. They're not saying where we're going to end the year, but they believe we're going to average 6.5%. That's where we're at right now. So they don't see much change throughout the rest of the year. Freddie Mac, they're at 6.4. They just do whatever Fannie says. Hey, Fannie, what do you got? I'm going to do the same thing. I'll make it look a little different. I'll go 6.4 if you're at 6.5. Moody's Analytics, the financial intelligence arm, says rates will average 6.5%. Okay, how about this? Let's go. We got this 5.25. Now we've got these 6.5s. Let's do a different over and under. Over or under 6% to end the year. Will we end the year in the 5s on mortgage interest rates, 30-year fixed, or will we be over? Will we be over or under 6% to end the year here in 2023 on the 30-year fixed? Just to finish this off, Goldman Sachs believes we're going to end the year at 6.5, and Realtor.com believes that Realtor.com are the most bearish. Realtor.com believes we are going to average 7.4% in 2023. It's interesting, right? If you're talking to somebody about, hey, where do you think rates are going to go? You could show them this study, and 9 experts are anywhere between 5.25 to, at the high side, 7.4. That's a 2% spread. It's very difficult for anyone to say to a buyer with confidence that you know exactly where the 30-year fixed is going throughout the rest of the year. There's too much uncertainty. Can you predict what's going to happen with the banking crisis? We've got an update for that before the end of the show. Can we predict what's going to happen with commercial real estate? No, we cannot. And so all the markets are going to respond differently depending on what happens throughout the year. Are we going to go into a recession? Are we not? And this is all going to impact what happens with the 10-year and what happens with the 30-year. I think they're over 6%. And we had a bunch of you chiming in here for over and unders. hovering around 6%. And again, it remains to be seen, right? We're gonna be speculating here on what it happens, and this is where some buyers, if you're advising a buyer, if you're a real estate agent, if you're a buyer agent, they're gonna have some fear about this. And so showing them the spread here's where it is right now. Now I can keep you up to date every single day. I can keep you up to the date on the minute on where the rates are, and if we're looking at a house and it's desirable and we're at a day where we're under 6.5 like we were to end last week, we may want to look at locking in. 6.3 like we were last week is right in the middle of this 7.4 and 5.25 number. Okay, that might not be a bad place to end up. It might be where the average is for the year. Okay, so nobody really knows where that's going. We'll continue to watch it throughout the year. What we do know is affordability is crushing the dream of many home shoppers to be able to go out and buy a home. And until we do get those rates down, it's going to be difficult in the foreseeable future to see affordability make more sense for more home shoppers. What hasn't made sense lately is home flipping. Home flipping profits fall to a new low. This is on nowbam.com. Sarah Lentz wrote the article. Adam just released its year-end 2022 home flipping report, showing a nationwide increase in home flipping, up 14% from 2021, up 58% from 2020, and reaching its highest point since at least 2005. Okay, so a lot more flippers have come out, especially in these low interest rate years of 2020 and 2021. Gross home flipping profits, however, dropped to their lowest level since 2008. Makes sense to me when these rates go through the roof. Home flipping in the U.S. has reached its highest level since at least 2005, but according to this new Adam report, home flipping profits have plunged to a new low. The year-end U.S. Home flipping report shows this 15% increase compared to the year before, and this 58% from 2020. The number of U.S. homes flipped by real estate investors in 2022 accounted for 8.4% of all home sales. 2022, 8.4%, almost 1 out of 10 homes was a flip. It's the highest share since at least 2005, and it's up 5.9% of share in 2021 and 5.8% in 2020. But given the number of home flips went up, gross margins have gone down. Very competitive, right? Makes sense. If you got that many people out there doing flips, it's going to be very competitive. Let's take a look at some of the data that we have down below. According to Adam, U.S. home flipping gross profits and return. Okay, so you've got a return under 30% in 2022. If you can't make 25% on a flip, you shouldn't do it. So still, this is just about at that 25% level for 2022. I'd imagine in 2023, where the rates are, this number could drop down even lower. 2008 was still above 20%, but on the downside of 25%. These are the two lowest years here on the chart since 2005 until today, 2008 and 2022. The lowest, I think 2023 will probably break that number. 20% and below, to me, on a house flip is just too risky. The numbers don't make sense. To hold a property, you could have delays. A lot of different things can happen. $67,900 was the gross profit on average for home flippers in 2022. Sounds like a lot of money, but you do pay considerable taxes on that. You do take a lot of risks. You hold up cash, and usually these projects can take anywhere from 4 to 8 months. And so, all things considered, might be a better place to put your money, certainly in 2023, when these values are being impacted, obviously, by the mortgage rate and your ability to carry the property. If you get a good deal and you know what you're doing, then totally different story. U.S. home flipping financing trends. Okay, total finance purchase dollar volume was 50 billion. That's a big number there. 50 billion total finance purchase dollar volume for 2022 on home flipping. It was under 40 billion in 21. It was just over 20 billion in 2020. Highest number since 2005. Okay. Percent purchased with financing Only 30 billion was purchased with financing of the 50 billion, where in 2005, I'm sorry, not 30 billion. Take that back on 2022. About 35% was purchased with financing in 2022 of the 50 billion. So less than 30 billion. 35% used financing. Now, 2005, when you had well over 50 billion financed, you had also 65% of that 50 plus billion that was financed. 65% of it was purchased with financing. Okay. So I'm sorry, 50 plus billion purchase dollar volume, 65% in 2005 financed, only 35% in 2022. That is a much better sign. It shows the strength of our mortgage industry, which we've talked about here on the hot sheet in the past. 2022 gross flipping return on investment by price range, less than $5 million, you're at 22%. Less than greater than 2 million, but less than 5 million. So 2 to 5 million, 21%, 1 million to 2 million, 24%, 750 to a million, 17%. These numbers here, 750 to a million, 500 to 750, 400 to 500, where you have 16, 17%. That's the danger zone to me. Okay. That's the danger zone. So if you're looking at flips between 400 and a million, and the gross flipping return on investment rather, is 16 to 17%, real risky there. So then 300 to 400, you've got 20%. And then you've got the highest range at 100,000, 100 million. I mean, these numbers don't make sense. 100 million here. Okay. There you go. Those charts are down below for you on the flipping report released by Adam, which you can advise any of your investors on what's going on right now if they're looking at a flip. Top 5 markets with the biggest increases in home flipping rates. Burlington, Vermont was up 283%. Came in at number 1. Prescott, Arizona. Bremerton, Washington. Jackson, Mississippi. Honolulu was in the top 5. Okay. The 2 metros that saw decrease in home flipping rates from 21 to 22, New Orleans and Green Bay. Okay. And then metros with populations of 1 million or more with the largest share of flipped homes purchased by investors with financing were led by Boston, San Diego, Seattle, Providence, Rhode Island, San Jose. Got some more local data in this report, which will be down below. It's on nowbam.com, or you can get it in the daily link with all of our sources and charts. Best counties to buy single family rentals. Okay. So if you can't do a flip, you still want to invest in real estate, where are the best opportunities for single family rentals? Adam, another report released in the past week. We saw its Q1 2023 single family return market report showing an increase in single family rental returns in 91% of the 212 counties analyzed. Markets, this is why Wall Street and institutional buyers have come into the single family market in a big way. Markets with the highest single family returns are concentrated in the Midwest, South, and Northeast, while those in the lowest returns are concentrated in the West. Rents are growing faster than home prices in most of the country and faster than wages in 2/3 of the markets analyzed. In your market right now, is it better to rent a single family home or flip it? Let's go rent or flip. If you're buying, let's say under that $400,000 number that we were talking about on the last chart, under 400 or under 500 if that's closer to the median for you. So let's just round up under 5,000. Better to rent single family investment or better to flip? Rent or flip? Where are you at in your market on that? Top 10 single family growth counties for 2023 with the greatest annual increases in rental returns. Let me know if you're in one of these communities. Camden, New Jersey, Cook County, Illinois, Indian River County, Florida, Gloucester County, New Jersey. I think that's how they say it in Mass. I don't know if that's how they say it in Jersey. Maybe somebody can correct me on that. Cuyahoga County, Ohio. I'm sure I butchered that. Shelby County, Tennessee. Polk County, Collier County, Florida, New Haven County, Connecticut, and Jefferson County in Louisiana. Those are your top 10 single family growth counties for 2023 with greatest annual increases in rental returns. That's down below for you. If you are in one of those markets, you may want to grab that. Rob Barber, the chief executive officer at Adam Research. The broader housing market didn't fare nearly as well in 2022 as it did in 21. Prices finally hit the wall, at least temporarily, but that appears to be benefiting the growing number of investors around the U.S. who rent out single-family properties. Rents for single-family homes are growing while prices have flattened out, which has helped boost yields for landlords for the first time in at least several years. The spread on a $350,000 home right now from renting it to owning it is upwards of $1,000. So you may see rents on single family homes increase a little bit when there's that much of a spread, right? If people are going to that want a single family home are going to move this year, they may look at that $1,000 savings, but be willing to pay a couple $100 more, which could drive up single family rentals. I think overall rent prices, and we've talked about this a bunch, should come down. We have a bunch of inventory hitting the market on multifamily properties this year, pent up inventory on these big commercial multifamily buildings which have been built, which are going to hit the market. Those are apartments, obviously, which should drive down overall rent cost. And some of these investors are going to be really incentivized to get full occupancy with where commercial real estate loans might be heading in the near future. That is a hot topic of discussion. The top 50 single family rental returns for counties include 29 in the South, 13 in the Midwest, and 8 in the Northeast. None of the top 50 markets for single family rental returns were in the West. A lot of people love the single family rental market in California, but that's an appreciation play. California on single family rentals is an appreciation play, not a rental return play. And not one market in the West was in the top 50 single family rental returns for counties in Adam's 2023 analysis. Okay, so there you go. If you're in one of those markets and you're advising somebody on their return in the West, it's basically non-existent. It's an appreciation play, and the data is down below for you. And with a bunch of other local data in that report, I could have gone on forever there, but that's down below for you, or it's on nowbam.com if you want to grab that yourself. Banking crisis has definitely tipped the U.S. closer to a recession, warns top Fed official who was at the center of the 2008 bailout. Okay, who is this guy? On Sunday, Minneapolis Fed boss. The Fed boss sounds like the mafioso. Neil Kashkari predicted that the combination of depreciating long-dated securities held by banks, often Treasury and government agencies' bonds, as well as loans granted to the troubled office real estate market, would likely trigger further losses in the financial sector. And yes, this has recession ramifications. Okay, so that is the new consensus here coming off of the banking crisis. Things have kind of leveled out. They've been quiet the last few days to end the week last week and to start the week this week, but that this has looming recession ramifications. Capital markets have been freezing the banking sector's perceived weaker regional lenders out of the credit system, he argued, starving them of access to liquidity and increasing the chances that economic activity would shrink, potentially to the point of a recession that, in the words of the Wall Street Journal's Nick Timiraos, has been predicted to be about 6 months away for well over a year now. You keep hearing that recession is 6 months away, and it just keeps getting pushed out. Hasn't happened. By the way, I saw a report that projected Q1 GDP growth might be up over 3%. So, I mean, I've always thought it's 2 quarters of GDP declining to put us in a recession. Obviously, they changed that definition last year when it happened. But if Q1 was up over 3% of GDP growth, it'd be hard to imagine, based off historical definition of what a recession is, that we are in a recession now. There are certainly other indicators to consider, but 3+% of GDP growth. That's not a finalized number. That is a number that's been floated out there on the Twitterverse. It remains to be seen where that'll come at, but that'd be a huge number in quarter one. And quarter one was expected or projected rather to be up. Remember, the Fed wants it like lower than 2, but they don't want it to be negative. So 3% would be well above where the Fed would want GDP to come in. Kashkari, one of this year's 4 rotating regional Fed presidents that cast a vote on the policy setting, he votes in the FOMC that sets this national interest rate. He's a veteran of financial crises, and he's a native Ohioan. He first rose to prominence at the age of 35 after then Treasury Secretary Hank Paulson handpicked him in 2008 to administer the $700 billion in U.S. tax money bailout to banks. Okay, so that's his thoughts. We're closer to this recession. Interestingly, on the banks too, I saw in the Real Deal that First Citizens, that acquisition that we talked about here, SVP acquisition, includes real estate loans. Okay, so that they bought up, they left some stuff with the government, but they also took on some of the real estate loans. So interesting there. We're going to talk a little bit tomorrow. I didn't have time today, but there's a Wall Street Journal article out about the office market and specifically high-end buildings. So I definitely want to touch on that. That's the next shoe to drop. Many are predicting here in the economy. We're going to go deep on that on the hot sheet tomorrow. And just to back up what this Fed president of Minneapolis thinks, you also have Fannie Mae saying in just the last 24 hours that these bank failures may tip the U.S. economy into a recession. And again, we've heard this for the last year and a half. We're close to a recession. We're going into a recession. Powell, I covered this last week during his speech. He seemed like recession was foregone conclusion. So it's been said for a long time. They continue to stand by that. Inflation has now been joined by financial stability concerns as threats to sustained growth. This is Fannie Mae chief economist Doug Duncan reading off of mpamag.com, a mortgage site here. Okay, so there you go on the bank update and recession update. More of the same. Quiet is good in the banking world. But we'll see what happens here over the rest of the year. Yesterday, what we saw happen was a 30-year fixed rate jump up over 6.5. I should start taking odds on this. If you watched yesterday's hot sheet, I said we'd be right around 6.5 based on what the 10-year was showing us in the morning. We ended out at 6.54. I think Pat Kenny, my buddy Pat Kenny, who's a financial planner, he said on Twitter, he said maybe we would do BAM bets. Maybe we'll start BAM bets. Let me know in the comments if you want some BAM bets. 6.54 is where we ended the day yesterday. Let's take a look at what the 10-year is doing right now. It's up a tick, so not up much, but up a tick. We're at 3.546. So our hopes of getting back under 6.5 on the 30-year fixed when we get a read today are not very high. Okay. Today we've got Real Word at 2 p.m. premiering at 2 p.m. on the channel. Make sure you subscribe to the channel so you don't miss an episode. And the Real Word, we've got fake realtor ads. This is a bombshell of a story which will blow your mind. We're gonna cover that. I'm also reacting to a Patrick Bet-David clip where he debates Barry Habib, mortgage guy. So you don't want to miss that one. And then today at 3:00 live, we've got an exclusive webinar, not on the channel. So you've got to sign up below with formations. It's the last call, everything you need to know before the looming tax day in April. So make sure you sign up for that below. It won't be on YouTube. If you want to join us at 3:00, formations make taxes suck less. And I will be with the CEO on preparing everyone what they need to know before April's tax day. Okay. I hope you enjoyed the hot sheet. I enjoyed being here with you. And until tomorrow, toodaloo.